We are going to be trying out a new high-powered AI spreadsheet software that functions a lot like Excel, but in this version, we just tell the AI what we want it to do, and we let the AI do all of the work. So we're going to be walking through trying to figure out what would be the optimal way to allocate assets into a portfolio. And if you want to follow along with me, go ahead and click the link in the pinned comment or the description to get to this page on this software where you can sign up for a free account. So all you'll need to do is hit that use quadratic for free button, and then you'll have the opportunity to sign up for an account. After you've signed up for a free account, you should see a page that looks like this where you can go ahead and create a file. And then we can just go ahead and select create blank file from there. Now, if you'd like to make things easier on yourself, I'm going to have a download link available in the description and the pinned comment where you can download this Word document that has the prompts that I'm going to use to get the AI to do what we want it to do throughout this video. So feel free to go ahead and download that so you can follow along with what I'm doing in this video. Now, our first instruction that I have is to us, which is to switch to a certain AI model. So with this software, currently there are 3 AI models available to us. We have GPT-4o, and then we have 2 versions of Cloud 3.5 Sonnet. One is from Anthropic, the other from Bedrock. After playing around with the software for a little bit, I have a preference for this one, Cloud 3.5 Sonnet from Anthropic, because I feel like it's worked the best for me so far. Since I recorded this video a few days ago, Cloud has actually put out a new model, or 2 new models, Cloud 3.7 Sonnet and Cloud 3.7 Sonnet Thinking. So while in the video that you're watching, I'll be using that 3.5 Sonnet, you should go ahead and select Cloud 3.7 Sonnet Thinking because it's even better. Now, you might be watching this even further and further into the future where new models have been added. So maybe you play with the newer ones at whatever time you're watching this. It's amazing how fast these things change in the world of AI. So now that I'm on that one, I'm going to go ahead and get the first instruction that I created. So we want to install the necessary libraries, and we can do that by taking this instruction, micro pip install a certain version of Y Finance and the economic data API from the government FRED API, and we want to output if successful. So I'm going to hit Control C to copy that. I'll go here and hit Control V to paste. And now I'm going to hit this blue button just to run it. And you'll see that it's thinking now, and it's actually going to go ahead and write some code. We can see it wrote 11 lines of code, and then it said it successfully installed both of these. So I think we should be good, and I think we have the libraries that we need. So now I'm going to go ahead and get that off of our spreadsheet by hitting the delete key. And I'm going to go back to the Word document. So in order to do this portfolio optimization, we're going to need historical data to be able to figure out what are the best assets for us to include in our portfolio. So now we're going to go ahead and do the data retrieval. So we're going to tell the AI to return 10 years, starting with today's date of historical day end adjusted close stock prices using Y Finance and Python. Why adjusted close? Well, adjusted close prices include both dividends and stock splits, so they'll be more accurate for us. We do not need any other columns. Use the following tickers. So I did 5 different ETFs. And the reason I picked these is because they're the largest ones that represent their sector asset class. So this is the biggest ETF for United States stocks. It represents the S&P 500 index. This one is the biggest ETF that represents stocks outside the US. This one is the biggest ETF that represents the bond market. This is the biggest commodity-based ETF, which represents or follows the price of gold. And then this one is the biggest real estate ETF. So we want to look at all of them and see what's the best ones to put in our portfolio and what percent of our portfolio should we allocate to them. So we're telling it there should be 6 total columns, 1 with dates and 5 with adjusted close prices. We need to ensure the column headers are correct, and we need to import all the necessary libraries. So let's grab that with Control C. Come over here. We'll get rid of the last one. Control A to highlight all. Control V to paste. And then I'm going to run that. All right, it took a few seconds, maybe 3 seconds to run. Now this Python code, it wrote 27 lines and it put it into cell A1, and it's currently trying to execute this. The reason that it might be taking some time is that it might be a lot of data that needs to be downloaded from Yahoo Finance. And there we go. It looks like we got it correctly on the very first try. We've got all the way up to today's date with new data. So that is great. Let's move on to our next step, which is now we need to figure out what were the daily returns of each of those stock prices. So I've wrote this one that we need to calculate the daily log return for each column with a ticker header. Do not include the date column. The log return should be calculated as the natural logarithm of today's price divided by yesterday's price. Don't worry too much. There's just a way we can calculate day over day returns, and this way is going to be easier to annualize. Don't get too caught up in what sounds like a complex idea. It's really simple. Keep the date column unchanged in the final output. Import all necessary libraries. The output should be a new table with column headers. So I like to be more thorough with these prompts than less thorough, just because I feel like it leaves less room for the AI to make mistakes, but you could perhaps leave out some of those details. So I'm going to hit Control A, Control V to paste. So we've got our whole new prompt here. We can see that we're currently selecting B1 with the cursor. I'm going to go ahead and select H1 with the cursor. And if I want it to output in a certain spot, one thing I can do is go after here and say start output in H1, and that will make sure or guide it as to where I want it to put this new data. So we can see it wrote 15 lines of code all in H1, and we see here that there is an error. So what is the error? It tells me right there in that highlighted red text. So now what I'm going to do is hit fix with AI. And sometimes it's pretty simple reasons that a mistake happens. So now what we're going to see is the AI is going to look at it and try to figure out what happened. So it's going to fix the error by using the correct function. The error occurs because we need to use this log function. So I'm now going to allow it to apply and run with the changed code. I'll hit accept. And so we still have an error. So it's kind of funny. Sometimes if you get an error doing more complex things, you can just then go hit fix in AI chat, and it's almost like this loop where it tries something, it might not work, tries a new thing, you hit apply and run, and then it might not work, you hit fix in chat. And I've done these loops before where it loops a few times and eventually gives me the right output. So it looks like we got it to work. I did that loop a few times, maybe 3 or 4 times, and now we seem to have our log returns. One thing I might do, because it had a little trouble with that, is just do a little test where I calculate one of the returns myself. So it looks like for this day, the return for SPY, if we do the log normal return, is equal to ln of 1 day's value divided by the previous day's value. And let's try that. So that gives us that 0.0028, or what would be 0.28% return for that day. It went up by 0.28% from here to here. And we see that that looks correct. That matches that value. And I could drag it down, try a few more, see that this matches this matches this. And I could even drag it over just to the right if I wanted to check the other ones, but I'm just going to go ahead and trust that we got our calculation squared away at this time. Now we have our returns, but what do we want to do with these returns? So we can go ahead and basically annualize them to see what was the annual return over the 10-year period in the past, and what was the standard deviation of these assets. So we want to get a feel for their return and the risk to figure out how we might want to allocate funds to them going forward into the future. So what we can do to do that is go and grab our next prompt, which says now calculate the annual returns and standard deviation for all 5 tickers based on their daily log returns. So this is the table of data that we just pulled on the last one. We want to keep them in percentage form. The table should be 3 columns. We'll have ticker, return, and standard deviation. and we're going to import all necessary libraries. So I'll copy that with Control C. I'm going to go over here and paste with Control V. And then I'll throw my ticker over here, or my mouse over here. And I'm going to say, I want to give a specific instruction that I want it to go into that cell O2. So I'm going to say output into O2. And now, oh, I said O1. So let's say O2. Now let's run that. So it started running. We have our headers on this table. And now it's writing more code. Let's see how it did. Oh, that looks pretty good. So we have this data here. It says that the S&P 500 over the past 10 years returned 12.43%, and had a standard deviation of 17.66%. So how did it do? Well, I actually created a little Excel spreadsheet where I did everything myself with my own math. And now let's compare the results. So here's the returns. SPY returned 12.43%. I have that value. IXUS 5.12, BND 1.42%, gold 8.55%, and then VNQ. So got all those right. Now let's look at the standard deviation. We got 17.66%, 17.14%, and it looks like those match up as well. So that was absolutely fantastic. So now let's go ahead and let's assign some weights that we can look at right now. So what I want to do is say, hey, how would we have done if we had put equal amounts of money into all 5 assets? So let's say we invested 20% into each one. So let's have it create basically a table of weights. So we're saying create a table of weights for each asset with headers. Start with equally, I'll make sure that's spelled right, equally weighted portfolio of 20% each. So let's see if the AI can handle that task. I'm going to override the old one again. And this time I'm going to tell it to output into maybe 09 right here. Say output into 09. And let's run that. So that one actually only took like a second to run. And we've got our table of weights of 20% each. Now let's go to our next instruction where we want to calculate the standard deviation of the whole portfolio. So this would be based on if we had 20% in each of the stocks in the portfolio and the stocks maintained the same standard deviations that they had in the past into the future. So that's an assumption we're making, that based on this past historical data, the standard deviation should be similar in the future. What would be the standard deviation of the whole portfolio, or the risk of the portfolio if we mix them all together? Theoretically, we should get some benefit if they're not perfectly positively correlated. This is the benefit of diversification. So let's go ahead and look at our next instruction. This one's a little bit longer because calculating portfolio standard deviation can be a little bit complicated. I'll show you a really quick example, and I'm not going to break down the formula too much. But for me to calculate portfolio standard deviation myself, I have to use a whole bunch of matrix math, and I have to do multiple times where I'm multiplying matrices and I'm transposing them and stuff, right? Like it's not an easy calculation to do. So we're going to have to give the AI some direction about this. So we're going to say calculate the portfolio standard deviation using the log returns of all ticker columns. That's what we calculated or created up here, that table of information. Make sure to treat the date column separately. Use the weight allocation, so our 20% allocated amongst each of the assets. First, compute the covariance matrix of the log returns. Then use matrix multiplication to calculate the portfolio variance. So then we take the square root. So this is a little inside baseball for finance people, but the variance, standard deviation, is the square root of variance. So we're just giving it some guidance. It should know that already in the AI model, but I want to make sure it doesn't screw up. Ensure only numeric columns are used in the calculation, and then write the final portfolio standard deviation to the spreadsheet with a header starting at cell S1. So this one I already put where I wanted it to output the information. Let's go back over here. I'll get rid of that and paste over with the new instruction. So I'm telling it to output it at S1 right there. Now let's go ahead and run that. So we ran that and we have an error, which isn't surprising because this is probably the most complicated thing that we've asked for so far. So I'm going to hover over that and then hit fix with AI. So it's currently analyzing the code itself to see why it's screwed up. So it's saying the error occurs because the weights data frame reference is incorrect. So it's saying this one's incorrect. Let's let it try to fix itself. We can go ahead and hit accept after we hit apply and run. That did not fix it. So now I'm going to do this loop again. Fix in AI chat. Okay, so we did our little loop where we let the AI code fix itself a few times, and now we're back. And we can hit accept to the changes because we can see that the standard deviation popped up. So I'll hit accept. It wrote all this code to do that. I'm going to X out of that. We can see that it calculated a portfolio standard deviation of 11.26%. Now I'm going to go to my human-made Excel template and see that it matches exactly the portfolio standard deviation that I had calculated here of 11.26%. So that's great. We are on track. Let's go to the next step. So now this is where we're going to calculate portfolio return. So we want to figure out what is our expected return for the whole portfolio going into the future based on the weights of the assets that we had assigned. So we're going to calculate the portfolio return based on the weights of each asset and the annual returns. Give it the header portfolio return. So I'm going to go over here. I'm going to override the last one. Control A, Control V, and there we go. We have it in there. I'm going to actually just tell it that I want it to output basically in S4. So let's say output in S4. Now I'm going to run that. And while it's running, let me give you a little disclaimer. So we're making our expected return assumptions based on these return characteristics here. And so why do I call attention to this? Well, these are what happened in the past. And just because these assets returned this thing over the past 10 years or these returns doesn't mean that's what's going to happen in the future. But we don't really have data that's better than these values here. So what you could do is use expected return estimates that are based on your own expectations. Like maybe you think this is going to return 8% and this is going to return 5% or something like that. You could do it that way. But we're just going to go with the historical return. So we ran it, we got an error. Let's go there and hit fix with AI, see why it didn't work. So it's having trouble with that weight table for some reason again. So let's hit apply and run. And then it worked on the first iteration of asking the code to fix itself. I'm going to hit accept. And now we see the portfolio return that it gave us of 6.46%. Let me go to my model and see if that matches. Yep, I also got a portfolio return of 6.46% when I did it by hand. So that's perfect. We are well on our way. Let's go take a look at the next step. So now this is where we're going to be looking at data from the government. I want to call out why we're doing this. So basically, we're going to use a ratio that uses the risk-free rate, which we can get from taking information from the US Treasury. So the Sharpe ratio is a ratio we can use to see how well our portfolio is performing. It takes our return that we get in excess of what a risk-free investment would get. So basically our risk premium for taking on this risky portfolio, and then dividing it by our portfolio's risk as measured by our portfolio standard deviation. So to use that ratio to see how much risk-adjusted return we're getting, we first need the risk-free rate. Now, what you actually need, if you want to do it this way, if you want to do it the way I'm going to do it, is you need an API key. And you can get an API key by basically just going to, if you go to Google, and then you look up Fred API key. Or I can also put a link to download the Fred API key in the description of this video too. And you'll come to something like this, and then you'll see the request or view API keys. If you don't already have an account, you can create one. So I'll put a link to that in the description. And so then once you get your API key, we can do something like this, where we say, retrieve the current 10-year treasury rate from the Fred API. Use this series. So this is just the series ID that tells it that it's the 10-year treasury to fetch the most recent available rate. Display the retrieved value in the spreadsheet with the header risk-free rate, and then use the API key. And then I put my own API key in there. And so I'm going to go ahead and put that into here. Now let's go ahead and run that one. And one thing I want to point out is if you don't want to go through this hassle of retrieving it with an API key, you could just Google like 10-year treasury yield, go click the first thing that pops up and use whatever rate pops up. This might be a slightly less accurate way to do it, but it should work fine, and it should be a little bit easier. So there we go. We have this output of the risk-free rate of 4.55%. And actually, if we go compare that to what we saw on this site over here, that's pretty much spot on. That says 4.54%. So that is great. So now we pretty much have everything that we need to calculate our Sharpe ratio, because the Sharpe ratio is going to be the portfolio's return minus the risk-free rate in the numerator. That will be our excess return, our risk premium. So this minus this, divided by the portfolio standard deviation, because we want to see how much excess return we're getting for the amount of risk we're taking. So let's go grab our next prompt, which is the prompt which is going to help us calculate the Sharpe ratio. So it says, calculate the Sharpe ratio for the current portfolio. Use the previously calculated portfolio standard deviation, portfolio return, and risk-free rate. So those three values we were looking at. Give it the header Sharpe ratio. So I'm going to Control-C to copy, come back over here, Control-A, Control-V. So we got rid of the last one. And I'm going to tell it that I want it to go into S10. So I'm going to say output in S10, and then I am going to run this. All right, it only took about 2 seconds. We get a Sharpe ratio value of 0.17. Let me compare that to my own. And I got a Sharpe ratio of 0.17 over here as well. So that's looking pretty good. We're matching everything. This wouldn't necessarily be a great Sharpe ratio. So I would say if you were getting a portfolio with these statistics, you would not be super happy. So what we're actually going to do now is tell the AI to do something a bit more complicated, which is to say, hey, we have all these things that we could possibly invest in. Should we be doing this? Should we equally be allocating amongst all 5? Or should we be overweighting certain asset classes because they perform better or they're better diversified amongst one another and give us a higher risk-adjusted return and a better expected Sharpe ratio into the future? This is this whole idea of portfolio optimization. And to do it yourself in Excel, it's a little bit complicated. So if we could write a query or a prompt for the AI to do it itself, that would be a lot of value. It would be easier for us. So I'm going to tell it perform a portfolio optimization to determine the optimal asset weights. So we just wanted to tell it what weights should we put our money into of the available options that maximize the Sharpe ratio. Use the previously calculated log returns, portfolio standard deviation, and risk-free rate. Use an optimization method to find the weights that result in the highest Sharpe ratio while ensuring that the weights sum to 1. So basically what I'm saying here is we don't want it to say put 50% in all 5, because then the weights would sum to 250%. Then we can't allocate more than 100% of our money. So we need the total to be that 100% of our money is invested in asset classes and no more than that. And no asset has a negative weight. So we're not allowing to short one asset class to go even more long in another asset class. We can only buy. Write the optimized weights to the spreadsheet with each asset's ticker symbol as a header. Also write the optimized Sharpe ratio to the spreadsheet with the header. So I'm going to go and grab all that. This is probably going to be the new most complicated thing that we ask it to do. So I'm going to go Control-A over the top of that, and then Control-V in our new instructions, and I'm just going to let it run. So this one actually took a lot longer, maybe 10 seconds. It wrote 53 lines of Python code and it tried to output it right here. So let's go ahead and see why. Let's hit fix with AI and give it a chance to correct itself. So it seems to have added a few lines of code. I'm going to hit apply and run and hit accept and see what happens. That didn't seem to work, so I'll now try again, fix in AI chat. So there we go. I did it, I think, 2 times where I let the AI try to fix itself, applied and ran, and it worked on the second time. I'll hit accept. So now here's our new optimized weights with our new optimized Sharpe ratio. So I did this just like the rest of this video. I did this myself in my own spreadsheet over here. So let's see how it compares. So it's saying to put 56.76% in SPY and 43.24% in GLD. So basically this is unconstrained. I didn't put any minimum or maximum weights. Let's see, it looks like it got it exactly the same. I'm gonna increase the basically the decimals so we can see. Yeah, so it's almost exactly the same. 56.84% versus 56.76%. And then 43.24% versus 43.16%, nearly identical. And then we both get an optimized Sharpe ratio of 52% on the Excel versus this AI model. So this is awesome. It seemed to work pretty much exactly how I would want it to work. And it beats our old Sharpe ratio. So it's basically looking and seeing that these asset classes had performed a lot stronger. It's assuming continued performance into the future that was reflective of how it performed in the past, and saying really we shouldn't be allocating to these 3 assets, just pretty much half and half into the S&P 500 and gold to get the highest possible Sharpe ratio. If we wanted to make this even more complicated, we could assign minimum and maximum weights, where we say basically no asset class could go beneath 10% weight or over 30% weight or something like that, and rerun it. But I'll leave you to experiment with these types of things yourself, because this file is going to be freely available to copy as a template. So you can take the file that I created here and mess around with it yourself by clicking the link in the pinned comment or the description. So please go ahead and check out this awesome AI spreadsheet software that I had a lot of fun playing around with. I've got some other use case ideas that I think I might try in the future with it. And thank you for watching this video.